Howdy, my friend, it's Paul from Squirrel On Charts, your resource for advanced trading education. Today, I'm going to talk about trend trading, especially 3 things that make beginners lose money while trading the trend. So, let's jump right in. Let's quickly recap the standard definition of a trend. A bullish trend can be seen as a series of higher highs and higher lows, as shown by the chart on the right. A bearish trend is the exact opposite. A bearish trend is defined by a series of lower lows and lower highs. Okay, now it's time to look at the first thing that causes many beginners to lose money while trading the trend. Many beginners love to trade once a situation is obvious. The problem is that this means they usually enter the market too late. On the left-hand picture, the market already went far into the trend's direction without pulling back. The breakout to a new high therefore already happened. On the right-hand chart, you can see the exact same situation in a bearish trend. So what's the problem of that? Well, the first problem is, at that point many traders and automated trading systems start securing parts of their profit. In addition, once the bullish move starts slowing down, the first traders enter the market to go short and bet on a move down. This causes the market to pull back. The problem is, at that point, the trader who entered late in the move often closes the trade, thinking the market will continue to go down. When he sees the market going back up in the trend's direction, and therefore ending the pullback, he gets upset because the market is again doing the opposite of what he did. The easiest solution is to enter the trade during the pullback. Of course, you should only do that if you expect the market to continue the trend. Once the pullback is over and the market continues in the trend's direction, you can either take partial profits or keep the trade open as long as the trend still exists. If you want to enter a trend during a pullback, it's important to use the correct stop. I will talk more about stops later in this video. Let's talk about the second thing that costs beginners a ton of money. There are always multiple trends at any given point. Or in other words, the trend that you want to trade is simply a part of another larger trend. It's important to pay attention to the next higher trend size. This can be best explained with the 2 charts below. Say you wanted to trade the bearish trend on the left. If you go on a higher time frame or zoom out a bit, you will see that the bearish trend is just a pullback in a larger bullish trend. Therefore, you can't expect the bearish trend to continue for a long time. It's much more reasonable to trade a trend that aligns with the bigger trend above. Let's look at the 2 charts below. On the left-hand side, we have a normal bearish trend. If we zoom out or go on a higher time frame, we can see that this bearish trend is inside a larger bearish trend. This makes trading the trend on the left-hand chart much more reasonable, because more traders will go short, and the chance of the trend continuing increases. Time for the last point of this video. This one is all about your stop-loss placement. If you are in a good trade, make sure that you can only get stopped out when the trade is no longer valid. If you trade the trend, then a normal pullback shouldn't stop you out. There are 2 important types of stop losses. First, the initial stop loss you place when entering the trade. Many beginners want to limit their risks and therefore place the stop loss very close to the current price. Others just place the stop loss randomly. Given that you shouldn't get stopped out by normal market behavior, the only reasonable place for your stop loss is the low of the last pullback in a bull trend, or the high of the last pullback in a bearish trend. If you look at the chart on the right-hand side, you can see that the stop is below the low of the last pullback. This means that you will only get stopped out when the current trend gets broken. The next stop loss is your trailing stop loss. There is one major mistake I see many traders make. It goes back to the different trend sizes. I told you to look at the next higher trend to see if it aligns with the trend that you want to trade. But there are also smaller trends that are part of the trend that you trade. Look at the left-hand chart. You entered your trade during a pullback in a bull trend. A bit later the market pulled back, so you used the low of the pullback as a place for your stop loss. But is this pullback part of the trend that you want to trade? I would say no. In my opinion, it's part of a smaller trend. On the right-hand chart you can see that the market eventually pulled back deeper. This pullback, based on its size and depth, is much more likely part of the trend that you trade. Using the low of this pullback for your stop loss is reasonable. Okay, time to recap. First, make sure to enter a trend during a pullback. Second, always pay attention to the next bigger trend and if the trend you want to trade aligns with the bigger trend. And lastly, use reasonable places for both your initial stop loss, as well as your trailing stop loss. Alright, that's it for today. If you want to make the leap from beginner to advanced trader, make sure to subscribe. Wish you the best for your journey. Bye.